multi-generational planning secrets, how to avoid capital gains taxes and to support charities and to involve your family in win-win-win ways. We love the idea of charitable giving. I know, Mike, having run a nonprofit for 10 years, your first 10 years out of the Stanford Law School, you created America's first free legal aid program for the elderly. You were immersed in the nonprofit world, helped other people start nonprofits throughout the country to serve the elderly with free legal services. Let's talk about charitable giving. Why don't you lead us through that?
Our focus for the moment in part is on capital gains tax because, if you have an asset, a second piece of property, some stock that isn't giving you much income and you need income, you get a little worried about these things and you're tempted to sell because you need the money. If you sell, if it's gone up in value, what happens? You have capital gains tax exposure. Combined state and federal, it's a little over 30%. I mean, that's a lot. So if you sell an asset worth $1 million and you lose $300,000, that doesn't feel good. Then you have $700,000. That part's good, but you've given up a lot. And that doesn't always fit. So one option, one of the many ways of avoiding capital gains tax, not the only one, is to create something called a charitable remainder trust. The idea is this. You take the asset, you put it into a trust. It says ultimately whatever's left in this trust is going to go to a tax-exempt organization, the charity of your choice. Once the asset goes into that trust, it's sold. Now, because it's going to go to a charity, to a tax-exempt organization, when the asset is sold, there is no capital gains tax exposure. So in my simple example, the asset is sold. There's $1 million sitting there. The trust then says that you're going to get a rate of return, let's say 6%. Every year for the rest of your life. So that's a significant distribution every year, year after year. There's a number of different ways you can organize that, but the point is you're converting an illiquid asset into an income stream for you. You're ultimately going to benefit the charity of your choice with the money that remains. It can also be structured to benefit your kids. It involves your kids as well, particularly if you're setting up your own family foundation, and it can be the beneficiary. I love the idea of getting the next generation involved, kind of reinforcing and learning about your values. This whole approach can reflect and reinforce family values. Many people do it only for the tax reason. Many people do it only for the charitable giving reason. But again, you're achieving two important goals at the same time. Charitable giving, supporting the organization or organizations, plural, of your choice, locking in a significant income stream for yourself for the rest of your life. You're also removing that asset from your taxable estate, by the way, by converting it into this charitable remainder trust.
And if you create a family foundation, for example, your kids can be managers of that after you're gone. So, or even while you're still around, they can be managers and they can even get paid a reasonable salary for the time they spend on that. So it can provide some income, but their focus is on how can we use this money for good? How can we use this money to support wonderful causes? So many win-win ways to do this, and it can be tax benefited and can support causes you obviously really care about. So we love that idea, and it's a way where you have to work across generations if you want to involve your kids in this, and you should talk about this. It's easy to find us, Gilfix.com, 650-493-8070. Hey, we hope you enjoyed that. Like, comment, share it with someone who could benefit from this. Stay tuned for so much more free legal educational content on the Gilfix Law YouTube channel. Subscribe. Let's be in touch.